Ever wonder why the price of a currency pair seems to always bounce back from certain levels, no matter how hard it tries to push through? It's like there's an invisible force holding it back. Well, there is. This concept is known as support and resistance, and it's one of the most powerful tools in a trader's arsenal. In this video, we'll break down support and resistance, explain how to identify these levels, and show you why they're crucial to your success as a trader. Whether you're just starting out or you've been trading for a while, understanding these key levels is essential to reading the markets correctly. Before we dive in, make sure to hit that subscribe button and tap the notification bell so you're always in the loop with our latest updates. Let's get started. Stick around until the end of this video, because we're not just covering the basics. We'll also dive into advanced techniques for identifying strong support and resistance levels that can seriously boost your trading accuracy. What is support and resistance? Let's break it down. Let's start with the basics. Support and resistance are essential concepts in technical analysis. Think of them as invisible price barriers on a chart. Support is like the floor. It's a price level where the market tends to bounce back up instead of falling further. Resistance is like the ceiling. It's a price level where the market often stalls or reverses downward instead of breaking higher. These levels are crucial because they help traders identify potential entry and exit points, showing where the price might pause, reverse, or even break out. Whether you're a beginner or seasoned trader, mastering support and resistance can help you make smarter trading decisions. Think of support as the market's safety net. It's a price level where demand becomes strong enough to stop the price from falling further. Imagine dropping a ball onto a trampoline. It hits, absorbs the impact, and bounces back up. Similarly, when the price hits a support level, buyers step in and push it upward. Now, resistance works like a barrier overhead. It's the level where the price struggles to climb higher because supply outweighs demand. Sellers step in at this point, causing the price to reverse or stall, like a ball hitting an invisible ceiling and dropping back down. Understanding these levels helps traders predict potential turning points in the market, improving timing and decision-making. How to identify support and resistance on charts. Identifying support and resistance levels on a chart isn't always straightforward, but there are a few key strategies to make it easier. The first step is to look for areas where the price has reversed in the past. These are your historical support and resistance levels. If the price has bounced off a particular level multiple times, that's a strong indicator that this level is significant. Horizontal levels. The simplest form of support and resistance is a horizontal line drawn at a price level where the price has reversed direction in the past. These lines are static and remain constant over time, making them easy to spot and use as reference points. Trend lines. Trend lines can also act as dynamic support and resistance levels. In an uptrend, the trend line below the price acts as support. In a downtrend, the trend line above the price serves as resistance. By combining historical levels, horizontal lines, and trend lines, you can identify key zones where the price is likely to react, giving you a clearer view of market behavior. Here, we see that the price has tested a specific level 3 times. Each time, it has bounced back up, so this becomes our support. On the other side, we notice a resistance zone where price has struggled to break through several times. Look for zones, not exact levels. It's important to remember that support and resistance are not always exact price points. Instead, they form zones or areas where price tends to react. Why support and resistance matter in trading? Support and resistance levels are crucial because they give you insight into market sentiment. These levels represent points where buyers and sellers are most active, and their decisions can lead to significant price movements. When price reaches a support level, buyers step in, causing the price to move upward. If the price breaks below support, it may indicate a shift in market sentiment and the start of a potential downtrend. Resistance. Resistance represents a level where sellers are highly active. If the price fails to break above resistance, it suggests the market is hesitant to push higher. However, a break above resistance could signal the beginning of a new uptrend. Why it's important to traders. Traders use support and resistance levels to make more informed decisions about when to enter or exit the market. By identifying these levels, you can place stop losses, set targets, and even position yourself ahead of big market moves. Why it's important to traders. Traders use support and resistance levels to make more informed decisions about when to enter or exit the market. By identifying these levels, you can place stop losses, set targets, and even position yourself ahead of big market moves. Now that you understand the basics, let's take it a step further. To refine your use of support and resistance, you can combine them with other tools and strategies. Fibonacci retracements. Fibonacci levels often align with support and resistance levels, creating powerful confluence zones where price is likely to react. Moving averages. Moving averages can act as dynamic support or resistance, particularly in trending markets. For example, the 50-period moving average often serves as support in an uptrend or resistance in a downtrend. Price action patterns. Candlestick patterns like pin bars and engulfing candles often form at key support and resistance levels, providing powerful entry signals. Common pitfalls to avoid when using support and resistance levels. While support and resistance levels can be powerful tools in your trading strategy, they're not a magic formula for guaranteed success. Here are some frequent mistakes that traders make and how to avoid them. 1. Over-relying on exact price points. The problem: many traders treat support and resistance as precise, unbreakable lines. When the price temporarily moves above or below these levels, they panic and either enter or exit trades prematurely. The fix: understand that support and resistance are zones, not exact price points. Use tools like candlestick patterns, moving averages, or other indicators to confirm the validity of these zones before making decisions. 2. Ignoring the bigger picture. The problem: traders often focus solely on past levels of support or resistance without considering the current market context. A level that worked well during a sideways market may fail in a strong uptrend or downtrend. The fix: always analyze the overall trend and market sentiment. For instance, in a bullish market, resistance levels are more likely to break, while in a bearish market, support levels may give way. 3. Failing to adapt to market dynamics. The problem: markets are dynamic and constantly evolving. What was a strong support or resistance level last week might lose relevance due to changes in fundamentals or volatility. The fix: regularly update your analysis. Use tools like Fibonacci retracements or trend lines to identify new levels as market conditions shift. 4. Neglecting volume analysis. The problem: many traders overlook how volume affects the strength of support and resistance levels. A level tested with low volume is weaker compared to one backed by high volume. The fix: pay close attention to volume at these levels. A breakout with significant volume is more likely to hold than one with minimal activity. Just because a level has acted as support or resistance in the past doesn't mean it will always hold. Pay attention to the overall trend and the market environment. Look for confirmation. Always wait for confirmation before entering a trade at a support or resistance level. Look for signs of reversal, like candlestick patterns or momentum indicators. Use multiple time frames. To increase your accuracy, analyze support and resistance on different time frames. A support level on a daily chart may be more significant than one on an hourly chart. Let's look at a scenario you might encounter in the markets. Imagine the price revisits a key level multiple times and shows a clear reaction each time. Traders who spot this could consider entering a trade, anticipating a bounce. By combining this with additional confirmation, like a strong reversal candlestick pattern, the chances of success improve significantly. Here's how it plays out. The price reacts strongly at the level, forming a clear bullish signal, indicating buyer interest. A trader enters a long trade, aiming for the next logical target where the price might face resistance. As the market progresses, the trade moves in their favor, hitting the target and locking in a profitable outcome. This keeps it more flexible and universally applicable without losing the practical feel. To recap, understanding support and resistance is fundamental to successful trading. These levels act as psychological barriers, guiding price action and helping traders identify potential entry and exit points. Remember, these are zones, not exact price levels, and always use confirmation before placing trades. If this video was helpful, make sure to hit the like button and subscribe to the channel. Have you used support and resistance in your trading? Drop a comment below and share your experience. Also, let me know if you have any questions. I'll be happy to help. Thanks for sticking with me till the end. I hope this video gave you a solid understanding of support and resistance and how to use these levels in your trading. Until next time, happy trading, and see you in the next video.